Commercial real estate goes far beyond office towers. Investors are increasingly turning to niche properties like self-storage, small bay industrial, and medical offices for stable, scalable income. Self-storage benefits from life transitions, like downsizing or divorce, making it recession-resistant. Small bay industrial supports local businesses and e-commerce, offering reliable cash flow through long-term tenants who value functionality. Medical offices provide perhaps the most stability. Healthcare tenants invest heavily in custom build-outs, resulting in long leases and high renewal rates. These properties also respond well to demographic trends, especially an aging population. Many of these leases are structured as a triple net lease, pushing most expenses to tenants and allowing for more predictable income. When evaluating deals, look at cap rates, lease terms, and tenant profiles. By targeting specialized sectors, investors can access better yields, lower volatility, and more passive income streams than traditional residential assets provide.
Paul, you've called self-storage and small bay industrial boring but beautiful asset classes. What first convinced you that these niches could outperform traditional multifamily?
You know, I had written a book that was humbly titled The Perfect Investment about multifamily investing. And somebody got on a call with me and they said, I actually want to talk to you about self-storage. And I said, okay. And then I thought, oh man, I don't want to hear about this. But you know, what convinced me was he said, look, if I was renting an apartment to you for $1,000 a month and I raised the rate by 15%, you might move out rather than pay that extra $1,800 a year that you're locked in for. But if I'm renting you a self-storage unit for $100 a month and I raise it by 15%, you're probably not going to spend a weekend, get a U-Haul, get your buddies together to move your your treasures down the street just to save $15 a month, especially when it's on a month-to-month lease. That got my attention. And then I realized there were a lot of benefits to self-storage. Our company started investing in self-storage, mobile home parks, and other asset types. And we've been really happy with this investment class.
I love it. I love the stickiness that it has. Ken, you've scaled from small apartments to $2 billion in assets. What have you learned about choosing asset types that hold up in different market cycles?
Well, we've done self-storage, we've done office, we've done development, we've done retail, we've done industrial. I'm right now focused a lot on billboards because of the bonus depreciation you get in year one, plus a cash flow, and I'm trying to do that to offset tax. So I think being in these niches is really, really fun. However, the learning curve is high, and there are things that are easy, like for example, when I did a bunch of self-storage, it's easy to get in the game quickly. You could build them quickly. You don't need a lot of land. So the barriers to entry are less, than maybe a multifamily project, which takes me almost 2 years to build. So there are pros and cons to both, but I love all real estate classes. And I think at any time in the cycle, some are up, some are down. So you really, really need to know how to run them. Any surprising challenges with self-storage? Oh, for sure. Yeah. I mean, one of the things self-storage, been my experience, the ones that we've built, the ones that I've owned, they really have a lot to do with single family home construction. So as single family homes build out, people like to store their stuff. Yes, you can always say there's divorce and all that kind of stuff, and there always is those kinds of things. But but then what I've seen is you can do 2, 3, 4, 5 projects within a few square miles, and then all of a sudden you're competing against each other. Now, the same thing can happen in multifamily, the same thing can happen in office, but the barriers to entry, I think, you can build a self-storage on just 1 to 2 to 3 acres, and so that's the difference with a scalable multifamily. We need to build a good one. We need over 10 acres, right? And then there's massive zoning issues, and self-storage is nimble because a lot of times they're infill. You can rip down something. We just had one done in Scottsdale where they ripped down an old restaurant that had been closed, and a location. And so that one's crushing it. So it really is like anything else. It's one of those sectors that you got to be careful, like, because if you have 3 or 4 or 5, if you got an 8x10 and somebody's $10 less, half a block or 1 block or 2 blocks away, that's a problem. So, they're sensitive, price sensitive. And also, I don't like the value add side of it personally. Like there is really no value add. The market kind of sets the number. Whereas apartments, if I buy something in the 90s, let's say that, for, I don't know, 100, 100 a quarter, 150,000 a door, I can put 15, 20 grand into the side of the unit and get that rent bump. So there's kind of a forced equity that I never found in self-storage. I could be wrong. I know there's people that do it with tech efficiencies and stuff like that. But from a physical, what does the customer get? I haven't found anything that works for value add in self-storage.
Thank you. Yes, it sounds like that low barrier to entry is a double-edged sword. Neal, you're a recovering technologist. What data points or signals help you to identify promising but maybe overlooked property niches?
Niches inside of niches. So here's what I'd like to say. I like, medical offices. I like self-storage, and I like, small industrial. I don't like large industrial, but I like small industrial. But here's what I would say. Self-storage is dealing with one of the largest inventory releases in the US, 8.8% of inventory in the last 36 months. That's a lot. That's a huge amount. As people have already said, it's very easy to build storage because you get approval sooner and you build it faster. And so it's very easy for there to be a storage glut in a particular market and there to be a storage shortfall in a market that's 10 miles away. So I really want to point out that it's easy for investors to get carried away with, self-storage is the new multifamily, or industrial is the new multifamily, or it's medical offices. None of these are the new multifamily, and neither is multifamily itself the new multifamily. What we are basically saying is the market is actually more hyper-local today than it has ever been. There are markets, Phoenix is a perfect example, where there's 15,000 multifamily units coming in the next 18 months. That's a very challenging place to be. And then there are markets in the US, like Boston, for example, where it's very difficult to build new things, where we have a shortfall of about 10,000 units in a single market. And Boston is the lowest cap rate market in the US, bar San Francisco. So what I'd like to point out to people is, and people don't like to hear this because they want to hear us give you some kind of magical solution. Paul Moore says, this is the solution, or Ken says, this is the solution. Really, my message to all of you is these are all great asset classes and they're all horrible asset classes. It depends on where you're looking. So be hyper local and you will find lots and lots of amazing places where you can build or buy self-storage. And the same applies for all of these others. Having said that, at the current moment, I would say small industrial is probably in the best space in terms of not having overcapacity. There's lots of overcapacity in self-storage. There's lots of overcapacity in multifamily. I'm not so sure about the medical office. It's a much smaller space, but I would say that small industrial, I'm not seeing any evidence of overcapacity or overbuilding in that space. So big thumbs up from a point of view of just data analysis.
Jay, I want to ask you, how do you teach agents and investors to evaluate opportunity beyond their comfort zone? What's the one thing that they need to focus on first?
Well,
sorry, go ahead.
Oh, yeah. If you've got something to add, jump in. So the thing we don't ever want them to do is pretend to be an expert on something they're not. So I think the definition of a professional is when I know the answer, I'll give you the answer. When I don't know the answer, I will go find the best answer. So we leverage our network and we try to teach people to not give fake answers. I'm sorry, that's just like the worst kind of customer service you could possibly give. But we have a network that we can tap into for all of that. I wanted to piggyback on what Neal said there, because the thing about niches in general, whenever I think about this class, is I think of this and sometimes I get the yellow kind of warning light out. I'm thinking a lot of times when we have this conversation, people are chasing trends. And anytime you're chasing a trend, you may be by definition late. And I would just always encourage investing, whatever you're investing in, pick an asset class and learn how to understand value. How value is made and created is even better. And that shows you how to add value. So like, do you actually understand the value of what you're investing in? Otherwise, you're gambling. And I just feel like if you're going to pick a niche, go be an expert in it in a local market, because they are so different. We see trends. New Jersey is not like Austin, Texas right now. You've got a seller market in one place. We got a huge buyer market here.
A very important delineation between gambling and investing. Jay Scott, how do you evaluate whether an alternative commercial asset fits into your long-term strategy?
Yeah. So, I mean, just to piggyback on what everybody's already said, another thing that your audience should consider when investing in real estate is that every asset class is going to optimize for different types of returns. So in real estate, we typically see 4 types of return. We see cash flow, we see appreciation, we see tax benefits, and we may see what's referred to as loan amortization, where your tenants, whoever's renting your property, is paying down the loan, building equity in your favor. And every real estate asset class is going to deliver these returns in a different percentage, a different format. So you may invest in multifamily, where you may end up seeing a lot of cash flow, a little bit of tax benefits, some appreciation, some amortization. Other real estate asset classes may have a different mix. You may see more tax benefits or less tax benefits. You may see likely more appreciation value add or less appreciation value add. Might see more amortization or loan pay down or less, depending on loan to value ratios in that asset class. And so what I would recommend for any of your audience who might be looking to invest, especially passively in real estate, is to ask yourself, what are you looking for in terms of types of returns? Are you looking for cash flow? Do you need cash flow to live on? Are you looking for long-term growth and appreciation? Are you looking to offset some of your income through tax benefits? And then tailor your investment, the asset class that you choose to invest in, based on the specific types of returns you're looking for.
Neal, can you weigh in on this? Because I understand that the tax benefits were a huge motivation for you to get into real estate.
Very much so. And I think that nothing's really changed there. From the time, I had a big exit in 2013, tech company, and I needed those tax benefits. I live in California, and nothing's changed. I mean, if anything, with this new Republican administration coming in and the return to 100% bonus depreciation, I personally find it very difficult to invest out of real estate. I'm Excel spreadsheet driven, and I'm looking at post-tax returns. When I compare my post-tax returns with real estate, with whatever I've invested in lots of things outside of real estate, I can't really find anything. There's one tiny exception to that rule. I invest in syndications that are, were legal syndications. With that exception, I've actually never managed to beat my real estate returns as a investor myself. I'm not talking about as a general partner, just as a limited partner investor, especially if you're in a higher tax state, it's going to be hard to beat real estate. If you track every single investment you've ever made in your life, you're going to have a hard time beating real estate as an asset class.
It's a strong testimonial. Anybody else want to weigh in before we move on? Okay, go ahead.
Jay Papasan said that it's really important to pick one asset type and become an expert in that. Warren Buffett talks about having a circle of competence. And it doesn't matter how large or small it is. You just need to know where your edges are. Charlie Munger's friend, John Arrillaga, picked a circle of competence. He said, I want to be an expert at real estate within 1 mile of Stanford's campus. And you know what? That sounds like a really small circle, but he became a billionaire doing that. So I totally agree with you, Jay, on that.
I was just going to add, if you qualify as a real estate professional, cost segregation or bonus depreciation is kind of miraculous. And we're back to the full benefit of it right now. A lot of realtors out there don't realize they qualify as a full-time real estate agent to get that bonus depreciation. And it can offset a lot of income. And the rates you can do, especially with small commercial, are basically offsetting a lot of your cost of entry. So I just think it's one of the most miraculous benefits out there if you qualify.
Very
and
valuable.
I just add one thing, Andy. I think, a lot of people think that the deals are the problem, and they would be right. Like raising money because of people that are paying a lot in tax. If you just focus on that demographic, that's basically most high net worth people. They're all trying to figure out how to pay less tax legally. And so if you know, as Paul said, if you find your niche and you find something good and you build a track record, the money is there. The hard part is actually finding a deal. And when you jump all over the place into these different niches, your learning curve, like anything, is a lot steeper. You know, we've been doing multifamily for 30 years. We certainly don't know everything, but you know, we've gotten the heck beat out of us over those 30 years. And so, you know, so our saw is a little bit sharper than somebody who's just jumping in.
Yeah, healthy reminder that we usually learn best by making mistakes. So you have to allow yourself to make those mistakes in order to become an expert. Let's move on to segment 2.